Hello financial fans, welcome back to another stock analysis. Today we'll be covering Walgreens Boots Alliance, stock ticker WBA. Walgreens Boots Alliance is a global pharmacy-led health and well-being company that operates in over 25 countries. They offer customers a wide range of products and services including prescription drugs, consumer health products, and retail pharmacy services. They also provide healthcare services through their retail clinics and their specialty pharmacy services. In addition to their retail pharmacies, they also operate a number of distribution centers and manufacturing facilities to support their operations. Their goal is to be the first choice in health and daily living for customers, patients, and healthcare professionals. They currently operate over 13,000 locations, and currently they have a market cap of $31.7 billion. Their revenue in 2022 was $132.7 billion, and their dividend yield is currently sitting at 5.21%. 77% of their revenue is generated in the United States, 12% in Europe, excluding the United Kingdom, 9% in the United Kingdom, and the remaining 2% is in other countries. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease based on the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT has steadily gone up over the past years from 2013 to 2021. Sadly, it's not visible on the graph since the margins of Walgreens are very low, but the average growth during this period in EBIT was 2.8%, meaning no change in our margin of safety. The margin is however visible and went from 2.88% in 2013 to 2.4% in 2021, so it decreased. During this time, the average growth was minus 1.06%, meaning a 5% increase in our margin of safety. The next 2 ratios are the dividend growth and the payout ratio. The dividend has gone from 66 cents a share in 2013 to 84 cents a share in 2021, with a big drop going from 2014 to 2015. The average growth in dividends during this period was 5.3%, meaning no change in our margin of safety. The payout ratio is sitting at a very solid 29.4%, meaning there's still room for Walgreens to increase their dividends further, which in our scale means a 5% deduction from our margin of safety. The last 2 ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to look at the debt, subtract the cash, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the companies to pay off all of our debts. For Walgreens, it's almost 3 years, meaning an almost 300% debt to EBITDA ratio, which means no change in a margin of safety, by just a sliver. The return on invested capital for Walgreens is 7.6%, meaning once again no change in a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Walgreens. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow from Walgreens going from 2012 to 2021. The average growth in cash flow during this period was 11.08%. Since we're calculating a lifetime expected growth of the free cash flow in the company, I've gone with a conservative 20% of this average, which is 2.22%. With this percentage, we can determine the future free cash flow of Walgreens going from 2022 to 2030, and determine a terminal year of valuation by using a perpetual growth rate of 3% and a discount rate of 8.5%. Together, summing all of the free cash flow together, we get a valuation of just under $85 billion. All we have to do to get our equity value is take our sum of free cash flow, add the cash and equivalents, and subtract the total debt. Doing this, we get an equity value of $51.7 billion. And the last thing we have to do to get a discounted cash flow price per share is divide it by the amount of shares outstanding. In this case, it's 862 million shares. Doing this, we get a discounted cash flow price per share of $60.03. And with the current price of $46.90, we get an upside of $13.84, which is almost a 30% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts from 4 years ago to the current year. The average growth in dividends during this period was 4.58%. And since we're once again calculating the lifetime expected growth in dividends for the company, I've gone with 70% of the growth rate, which is 3.2% growth. Well, once again, we're using a discount rate of 8.5% in this calculation. And doing this calculation, we get a dividend discount model price per share of $37.21. With the current price of $46.19, the upside here is a downside of almost $9, which is a 19.44% downside. Last model that we'll be using is the multiple valuation. By looking at companies that are similar to Walgreens, looking at the stock price and their earnings per share, we can determine the PE multiple of the industry. We can determine the average PE multiple in the industry. In this case, the average PE ratio here is 13.06. All that's left to do to get our fair value here is multiply it by the earnings per share that Walgreens is generating, which is $5.03 per share. The fair value here is $65.67. And with the current price of once again $46.19, the upside here is $19.48, which is an upside of over 42%. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, and a multiple valuation price per share. Out of this, we get an average of $54.31. If we were to not use a margin of safety, the upside here will be 17.57%. But we have calculated our margin of safety earlier by using a standard margin of safety of 25%, adding 5% because of the margin growth, and deducting 5% for the payout ratio, which leaves us with a 25% margin of safety. When this is applied, we get a fair value of $40.73. And with the current price of $46.19, we get actually a downside of 11.8%. So, looking at our valuation models, in this case, it's a sell. If there are any other companies that you would like to see on this channel, please let me know in the comments. And thanks for watching.